Thanks for clicking. All eyes were on the Bank of Canada this morning, with the majority of economists predicting a 50 basis point rate hike.
Don't screw this up.
Indeed, with Canada's inflation rate sitting at 6.8%, the bank has been under increased pressure to get control over Canada's CPI. Food prices have risen almost 10% in the past year, and shelter prices have risen close to 7%. Not to disappoint, the Bank of Canada raised interest rates by 50 basis points, hoping this will put a dent in Canada's surging inflation rate. So what I want to do today is go over the Bank of Canada's interest rate hike, discuss how that rate hike will affect mortgage rates in the short term, and then go over how long it should take for this rate hike to filter into our inflation rate. Then we'll discuss what to look for next. Speaking of what to look for next, it's the first of the month, and we're expecting to get the data from the local real estate boards out any day now, with many expecting double-digit decreases in our home prices. We'll obviously have updates out on that data on this channel. Click like and subscribe to get those updates, but for now, let's get into these rate hikes. As mentioned, the Bank of Canada raised interest rates this morning by 50 basis points, bringing its key policy rate to 1.5%, which is 125 basis points higher than its pandemic lows, inching closer to pre-pandemic rates of 1.75%. However, it's unlikely that this rate announcement is going to do anything to mortgage rates in the short term, as in the next week or so. The majority of the banks and mortgage lenders saw this interest rate hike coming a mile away.
Why didn't you tell the rest of us?
And have already largely priced in these interest rate hikes to account for the higher cost of borrowing in their mortgage rates. With that said, I think if the inflation rate goes much higher than 6.8%, if we start to see it get closer to the US inflation rate of 8.5%, then I think we'll start to see mortgage rates jump up again, as the writing is going to be on the wall that the Bank of Canada is going to be raising rates again and probably higher in July, maybe another 50 basis point rate hike. But the real question is, will these interest rate hikes bring Canada's inflation rate back down to that 2 to 3% target range in short order? Probably not, and they're not intended to, at least not in short order. While the rise in interest rates are meant to cool down spending, to slow down the economy, it doesn't happen overnight, and it takes a while for these higher costs of borrowing to filter through the rest of the economy to slow down price increases.
How long?
Scotiabank's chief economist recently noted that it could take 18 to 24 months for these rising interest rates to show up in our inflation rate. Others say it could take up to 12 months, but one thing is for sure, it's not going to happen within the next couple weeks, couple months. It does take a while for these higher costs of borrowing to filter their way through the economy as a whole. What these interest rate hikes are intended to do is to, one, change people's spending habits, and two, restore confidence in the Bank of Canada and Tiff Macklem's ability to get control over the rate of inflation. One of the main concerns of the Bank of Canada is that inflation expectations are going to get unmoored. That is, people expecting higher prices in the future will spend the money now, which creates an artificially higher demand, which pumps up our inflation rate even more, creating a self-reinforcing loop.
The lesson from history is that if inflation expectations become unmoored, it becomes much more costly to get inflation back to target.
According to Bloomberg, the 125 basis point rate hikes that we've seen thus far are front-loading a force aimed at convincing households and companies the inflation spike won't last, before they start recalibrating their expectations higher for wages and prices. And it looks as though these rate hikes are starting to work. A report came out in April showing that Canadians are starting to hold off their car purchases amid skyrocketing used car prices. While 4 in 10 are changing their purchasing plans, 13% are holding off on their purchases altogether. We're also seeing a major slowdown in Canada's real estate market, with the prices of homes and number of homes sold dropping significantly over the past few months. So when we see stories of people holding off on their car purchases, holding off on getting into the real estate market, they're holding off in large part due to these skyrocketing prices in the hopes that prices will come down. And this is exactly what the Bank of Canada wants. They want Canadians thinking that the Bank of Canada has control over the inflation rate, and these nearly unprecedented price hikes, unprecedented for the last 3 decades at least, these unprecedented price hikes won't last forever.
It'll all be over soon.
Now, it's important to note that the Bank of Canada doesn't want to see, with the exception of real estate, prices decline too much. In fact, they don't want to see prices decline at all, as that would be deflation, which carries with it a whole host of other problems. So, the Bank of Canada doesn't want to see prices reverse. They don't want things to get cheaper. They do want to see prices slow down. They don't want to see those year-over-year 10% growth rate in our groceries, in our gas, in our shelter costs. They want to see prices go up 2 to 3% per year, but that's well within their target range, and then Canadians can be confident that they don't need to spend now for fear that prices will rise later. With that said, we will have a much better idea how the previous rate hikes have affected the real estate market in the coming days, as we're set to receive that local real estate board data. If you want to get those updates, make sure you click like and subscribe, and thanks so much for watching.